Hey, Money Masters. Good Friday morning to you. Yes, this is not our normal time. Normally we're here on Thursdays. And so not our normal time, right? But I have my 2-year-old grandson with me. And so how many of you all know that sometimes they can dictate what your day looks like, right? So nonetheless, here we are. We're here with episode 42, and we are going to give me just a second in the gray bag in my room. Oh, okay. Sorry, y'all. I'm so sorry. This live. We got a house full. We got people visiting. The grandson is here. Everything is going on. But anyway, sorry about that. Episode 42. Let me know if you can hear me or not. I'm also having some issues with the microphone, but I think we're going to make it. All right. So the topic at hand today is um, your retirement account took a beating. Now what? Okay. And what I'm going to share today is especially relevant for those who are. Good morning, Cheryl. Good to see you. It's especially relevant for those who are close to retirement. Okay, maybe you are in your 50s, late 50s, headed into your 60s. But it's not just for those who are close to retirement. Some of these strategies may benefit you just anyway, right? Because we know that last year, people's 401ks took a beating, right? And even if it wasn't a 401k, your IRAs, other things that you had invested in the market, those things took a beating last year. They continue to, kind of go up and down this year. So we want to talk about it. And I'm going to share with you some traditional and non-traditional ways in which you can catch up. And we'll talk more about that in a minute. But first, our crazy money story for the week, our crazy money story for the week. So I thought I would go back for this crazy money story, go back in time, right? To a time where they were experiencing a lot of uncertainty. And that time would be in the 30s during the Great Depression. And I wanted to share a couple of stories of people who made big money during that time. Yep, they made big money during that time because how many of you know that in times of uncertainty or in times of economic upheaval, those are the times when your next millionaire or billionaires are made, right? And the reason why that happens is because these people, instead of focusing on what isn't going right in the economy, they're looking at, okay, yes, things aren't going right, but what exactly can I take advantage of during this time that will allow me to create wealth even in the midst of a depression, right? So if people could become millionaires and billionaires during the Great Depression, and not only did we see it in the Great Depression, we also saw it in 2008, and we've seen it in many other times when the economy is down, right? So I wanted to share just a couple of stories and pay attention to like what industries they specifically got into, because interestingly enough, I believe that those industries still today, even in our economic uncertainty, may be some ways out. And of course, with we've got some new things that have come along, like crypto and all of those things. But pay attention, okay? All right. So first, I want to share with you Joseph Kennedy. Okay, so Joseph Kennedy, how did he get wealthy during the Depression, or wealthier, I should say, and he chose to invest in stocks, movies, and spirits. Now, while we here at Money Mastery for Her, we don't encourage anybody to invest in spirits, he decided, hey, look, I'm going to invest in spirits. And it makes sense, right? Because people during these times, what are they going to do? They're going to drink. They're going to drink during good times. They're going to drink during bad times, unfortunately. Okay. So he made his millions in the unregulated stock market of the 1920s. Um, and during that time, he decided that he was going to get into the movie business. So he purchased a failing Hollywood studio in 1926. Now, most people aren't typically going to look at purchasing failing businesses, but um, a lot of wealthy people, you look at people like Elon Musk and others, a lot of them have in their portfolio businesses that they purchased that were failing, okay, and now have made them big profits, big profits. So he purchased a failing Hollywood studio in 1926. He consolidated movie companies, okay, that were putting out low budget movies. He made them more efficient and he sold them for big profits. So he didn't keep these companies. He purchased them, he made them more efficient, then he sold them. So by the time he exited Hollywood, he had earned 5 million in the film industry. And think about that. That was 5 million back in the 1930s. Okay. So while most investors watched their fortunes go away during that time, he came out of it even wealthier. And at that time, he believed Wall Street was overvalued. So he sold most of his stock just before the crash and made even more money by selling them short, right? What did that mean, selling them short? He was betting on stock prices to fall. So he was paying attention to what was going on in the economy and he took advantage of it. Okay. So that was one way. All right. Another one, I'm not going to get too much into his story, but J. Paul Getty was another one who became even wealthier during that time. And he did it through oil stocks and real estate. Mae West, who is a movie star. So she did hers through movies, right? So again, think about it in uncertain times, the things that people do, right? Um, Same today, right? What are we looking at? It may not necessarily be movies, or it could be movies, but now we've got all the streaming and all of those things. I mean, it's definitely an industry to get into. All right. And then I wanted to share this last one that I'll share, Charles Clinton Spalding. He came to be known as America's largest Black-owned business, North Carolina Mutual Life Insurance Company. Okay, so he created his wealth during that time through insurance. And let it be known that insurance and most of the areas within financial services is a way to go during economic uncertain times, because whether times are good or whether times are bad, people need to, know what to do with their money. They need to, insure certain things, all of that, right? So his was done through specifically, he expanded into fire insurance, and then he also expanded into banking and mortgage lines. Okay. And when he started out, he was operating out of rented desk space in the corner of a doctor's office. And when he grew into a 6-story office building that anchored what they call Black Wall Street in Durham, North Carolina. Okay, so while many Black people were suffering the highest unemployment rates during that time, he was widely seen as the country's leading Black businessman. And so his story is a great one if you ever get time to watch it. Another person, Michael Cullen, did his through groceries. Okay, so these aren't like some super inventive things. You got oil, you got movies, you got insurance, you got groceries. Like these are things that people are going to need and use all the time, right? And so that's how these people made their millions. Hey, good morning, Brother Salim. Good to see you all the way from Pakistan. Hope that you and your family and your ministry are doing well. All right, so that's our crazy money story. Not really necessarily crazy, but just to show you that it can be done then, still can be done now. That with economic uncertain times, it does not have to be a bad time for everyone if you are paying attention to where you can go, okay, during this time to create wealth. All right. So let's get to our main topic for the day. Today, we're talking about your retirement. It took a beating last year. And so, what strategies can you take advantage of so that you can catch up, right? Get back to where you were. And I would say surpass where you were, especially if you are in your mid to late 50s, going into your 60s, and you were looking forward to retiring in the next couple of years, right? So I'm going to talk about the traditional ways first. Going to talk about the traditional ways first. Then I'm going to venture into the non-traditional ways. If you've been following me any amount of time, you know I slightly lean, not slightly, huh? I lean towards the more non-traditional ways. But let's go through the traditional ways first. So in the industry, what they will tell you in order for you to catch up, you took this beating last year in your 401ks and your IRAs. How can you catch up in your retirement savings? One of the things that they're going to tell you, or one of the first things they're going to tell you to do, is to max out your 401k and to max out your IRA. Okay. What does it mean to max out? It means to contribute the most that you are able to contribute within the guidelines to those investments. So, like for IRAs, you can contribute up to $6,500 per year. At a certain age, I believe it's 55. Don't quote me. You can contribute up to an extra 1,000. So instead of 6,500, you can contribute 7,500 per year, right? So they tell you to max out your 401k, max out your IRA. But how many of you know that for most people, that alone is not going to actually get them where they need to be? May help them catch up some, but may not catch up all the way or even surpass where they were, right? So they'll tell you, number one, max your retirement accounts out. The second thing that they're going to tell you is to work longer. Okay. And they're going to tell you to work longer for two reasons: because you can continue to contribute to your retirement accounts. Okay. And you won't start living on them sooner. They rather you start withdrawing from them later. But how many of you are like me and like, I don't want to be working later, right? Like they're telling you, you had planned to retire at 62 or 65. And now they're saying, oh, you probably need to work till 67 or 70 or 72 even, right? So that's another option, okay? It's not my favorite. I don't know if it's your favorite or not, but that is another option, right? That you can work longer than you plan to, okay? And the reason why you're having to do this catch up, right, is because money is in your 401ks, your IRAs, and things. They're not protected. They are subject to all of the ups and downs of the market, which is why typically when you hear me talk about retirement and me saying that when you get within 7 years of retirement, that you should be looking at how to protect what you have invested and grown so far, right? The profits that you've made so far. You've got to look at how can you start protecting those things. Anyway, let's keep moving. So work longer. The next they will tell you, again, which is along the lines of working longer or not, but they'll tell you to not withdraw from your Social Security until later, until like you're 70. Okay. You have a certain amount of time that you can push off withdrawing from your Social Security. And I believe it is up until age 70. And so they're telling you just wait until that time to withdraw, which is, again, keep working, right? Because if you can't withdraw from your retirement, you got to work. You got to have income coming in. So keep working until you're 70, 72 years old. And again, I don't know about y'all, but that is not my favorite. Okay. All right. So those are some traditional things that you're going to hear. If you have met with your advisor this year because you've been concerned about your the losses that you have in your retirement accounts or any of your investment accounts, these are probably some of the things that they have told you, and they really haven't given you any other options outside of, hey, find a way to contribute more. Okay. they haven't really given you many other options outside of that, right? Because they are traditional advisors. The products in which they provide, these are the options that you have. So I want to talk about a few different ways in which you can catch up non-traditionally. And traditional, advisors will say, "Oh, those things are very risky. You don't want to do that." But as you have learned, okay, is that you lost money last year anyway. You lost quite a bit of money last year anyway, right? Because those monies are not protected. So it always, interests me and when I say interest, I'm being funny. It always interests me that people will criticize non-traditional types of ways of investing, saying that they're risky and you can lose your money when you are already losing money, even in some traditional ways. Okay, so let's talk about some non-traditional things that you can do. All right, starting with your 401k or your 401k. Let's start there. There is something called in-service distributions. Okay, there are two kinds. You can take one out for financial hardship, and you can take one out if you are age 59 and a half and you are still working. You can take out in-service distributions. Okay, you have to check with your whoever's holding your 401k with the minimums and maximums and the guidelines and all of those things, how often you can do it, how much you can take out. I'm not sure that there are maximums per se, but it just depends, I think, on the situation. Um, I know with financial hardship in service withdrawals has to be no less than 1,000. And with financial hardship ones, they are technically supposed to go towards certain things. You have to prove that you have a hardship. So whether that is financial, whether it's a death in the family, there are some other things, right? Hospitalizations, you're on the brink of foreclosure. Those are some reasons in which you can do a financial hardship. If you're 59 and a half, you don't have to have a financial hardship to do it in service distribution. You're 59 and a half and you can start taking money out of your retirement. So now what do you do with those funds? Well, you take those funds and you can either, and these are just a couple of things that you can do, right? I can't sit here and talk about all the possibilities. We might be here all day. But you take those funds out, you can roll them into a self-directed IRA. Why a self-directed IRA? Why not just a regular IRA? Well, with a self-directed IRA, you can choose what to invest in. Okay, so you don't have to invest just in stocks, bonds, mutual funds, ETFs, but you can take that and invest in gold and silver. You can take it and invest in crypto. You can take it and invest in real estate, which would be one of my favorites, right? You have more control because you can take those monies and you can invest it as you see fit, right? And then yield better returns possibly than just a regular retirement account. Okay, so that's an option. You can also take an in-service distribution and use it for trading. Now, keep in mind, if it's not directly rolled over into another qualified account, then there will be some taxes to pay, right? But you'll work with your financial advisor, consultant, tax person, or whatever to figure all that out and make sure that you're not taking a hit that you don't need to take or shouldn't take, right? But you can also take those monies out and you can trade. Now, people will, when they hear trade, they're like, oh my gosh, this sounds so risky. But how many of you know that trading allows you to profit in the market, whether the market is up or whether the market is down? Okay. Now, certainly, if you don't know what you're doing, it could be even more risky, right? So you either will want to learn how to do it, which takes some time, right, to learn that, or you will trade passively, which means you will hire people who do this for a living. They're successful at it. They and allow them to trade on your behalf, where you earn passively. And so with trading, you can earn profits. You can earn profits daily. You can earn profits weekly. You can earn profits monthly. So it can definitely help you catch up very quickly and surpass, okay, what you even thought that you were going to be able to do, right? So trading is another non-traditional way. Again, most people are like, oh, that's super risky. I wouldn't do that. But again, this is a space where you can earn profits, whether the market is up or whether the market is down. Okay. To every investment, I'm going to put this out here, there is risk. Okay. So whether it's your 401k or whether you are trading, there is risk. Okay. And I'm also going to put out here while I'm talking that I do not know your personal situation. So what I am saying to you today is for educational purposes only. Okay. I'm not telling you to go take your money and go do this because I don't know your personal situation. All right. But you do have the opportunity to, if you do not have a financial advisor that you trust and is looking out for your best interests and is giving you options, even outside of traditional ones, you are welcome. I think in the pin comment, you can schedule a consultation with me and we can talk about your specific situation. Okay. All right. Another option is you can leverage the equity in your home. A lot of people don't think about this, right? Not for investing. They will think about taking out equity in their home to pay off debt, which I'm like, that's not what you want to do, because what happens is you are down to zero and you never want to be down to zero. What do I mean by being down to zero? Well, I mean, you take out a home equity loan, they call them HELOCs. And there are also some alternatives to HELOCs. I won't get into much of that today, but just so you know that there are some alternatives to a HELOC that may be a better option. But anyway, people will take out a line of credit against the equity on their home, and then they use it to pay off debt. And how many of you, when you pay off debt, you're not earning anything, you're not getting a return, right? So that means that you are making your way down to zero. If you took out 80,000 on a home equity line of credit and you're using that to pay off debt, not only do you have to pay off the debt, but now you have to turn around and pay off the home equity line of credit. And with what are you doing that with? I don't know. Maybe you have other plans to make more income or whatever the case may be, but it doesn't put you ahead of the game. So instead of taking the HELOC or the alternative to the HELOC and paying off debt, right? Maybe a portion of it, you might pay some debt, but take a portion of it and invest it and yield a return. Well, what can you do? Some other things, I already talked about day trading, but some other things that you can do is you can take a portion of it and you can put it in an IUL, right? Or you can take a portion of it and put it into hybrid annuities. So I would divvy it up into some different things because you have to pay off that line of credit, right? So you're going to need to invest in something that's going to yield you some income right away. And then I would take a portion and invest it in something that's going to yield me some income, maybe down the line, like the IUL or hybrid annuity. Why am I suggesting the IUL? The IUL is an alternative to retirement. It is a way in which you can build up savings. You can, if your IUL is structured properly, what's an IUL, Lexi? Index Universal Life Insurance Policy. Okay, this is why it's an alternative to retirement, because it's not technically a retirement savings or retirement investment account. It is an insurance policy that has cash value attached to it, meaning there's a savings that's attached to it that yields a return. And if your IUL is structured properly, then you have a floor, meaning that There is protection. Okay. So you can have the floor be at zero. So if the market hits below zero, -1, -5, -25, whatever negative, you are not going to experience that negative. You're not going to lose anything. Okay. Because your floor is at zero. And then typically it has a cap, meaning how much you can, the highest that you can gain. Okay. Where the market is concerned. So you're protected. And then when you need to live off of that income, you take what's called a policy loan, not a withdrawal because you'll pay taxes, but you take a policy loan, okay, and live off of that income. If you take a withdrawal, okay, you're going to pay taxes on it. That's why you don't want to take a withdrawal. You're going to take a policy loan and live off of that income. Now, you're going to say, well, isn't this life insurance? What happens if I pass away? Well, this is not the life insurance policy that you're going to use to take care of burial types of things, okay? This is the policy that you're using to create wealth, okay? So you could leverage your home equity in your home to get into some different types of investments. So IULs, hybrid annuities. You can do some trading for current equity, which I highly recommend because, and I'm not recommending for your personal situation because I don't know it, again, for educational purposes, but because you're going to need that current income, right? Because you've got to pay that line of credit back. So IULs, hybrid annuities, trading, real estate. Again, you can leverage a home equity line of credit to get into real estate. So maybe you purchase a property that doesn't need a whole lot of fix up, rent it out, right? Use the rental income to pay the line of equity, the HELOC, the line of equity, the line of credit, and then and then the rest of it to put up for retirement, right? These are all various different options, and there are more. And you need to be very strategic about them. You got to know your numbers. So if you follow me for any given time, you all know that I always say you need to know your financial independence number. What is that number? Okay. How much do you need in order to retire, stay retired, and live the life that you want to live? What does that look like? What income is that monthly, right? Is it 8,000 a month? Is it 10,000 a month? Is it 15,000 a month? Is it 3,000 a month? What is it, right? And then remember to take into consideration taxes and inflation, okay? So that you are, whatever types of investments that you get into to catch up, you're strategic about them because they're all working together to help you meet your financial independence number, okay? So we've gone through some traditional ways, and we've gone through a couple of non-traditional ways in which you can catch up, okay? Some of you guys say, well, I don't have a home equity, I don't have a home, maybe I don't have equity in my home, or, whatever the case may be. So same thing though, where can you start, right? The prophet Elisha asked the widow, what do you have in your hand? Where can you start? Do you have $100? Do you have $500? Do you have $5,000? Do you have 10,000, 20,000, 30,000? Of course, the more you have, you can get a bigger jump start. But what do you have in your hand? What can you start with? Because there are options in whatever, wherever you are financially, there are options, right? So think about that. Where can you start? Okay. You may not have equity in your home that you can go take out a HELOC or some alternative to a HELOC, but where can you start? Okay. Where can you start? Do you have 500? Where can you start? Okay. And the key then is to just get started. So yes, you took a beating in your 401k last year and your IRAs last year, but it's not over. There are still many things that you can do There are still options out there for you to be able to catch up, and even outside of the traditional things that you can catch up. So it just depends on, well, how tolerant are you for risk? Listen, everything is a risk. And whether you believe it or not, when you signed up to take part of that 401k or your IRA or whatever traditional types of retirement savings that you had, you were risking, okay, because there's no protection in the market for those particular types of things, right? So anyway, I'm going to leave it there because I'll start to get into a different conversation, which is, really how to protect what you have. We may talk about that in our next episode, but I just wanted to share, hey, if you've taken a beating in your investments, there are ways in which you can catch up outside of the traditional ways, right? Of just working longer, putting off your Social Security and, not drawing from it until you're age 70. Listen, with my clients, we don't even talk Social Security. We don't even think about it, right? Social Security, if you're collecting it, would just be that nice little extra cherry on top. It is never part of, I never recommend it to be part of one's, strategic plan for creating wealth. Um, Let it just be the little forgotten cherry on top, right? But anyway, hope that this has been helpful for you. If you have any questions, I didn't see any come in as I was talking here live, but if you have any questions later that come to you, feel free to put them in the comment thread wherever you've been watching. Thank you for watching. Thank you for taking time out and watching. And we should be back on our regular Thursday schedule next week, prayerfully. And other than that, that's it, y'all. Hope that you learned something today. Again, you're welcome, Peter. Thanks for tuning in. If I can assist you or you want to talk about this more in depth, you can set an appointment with me on my calendar, okay? And I'm going to post it here. It's also in the comments. You can schedule time. We can talk about your specific situation and what some options for you may be, okay? Other than that, what's coming up? Well, this Saturday, tomorrow, we are back doing our Saturday broadcast hosted by none other than Juanita Corey Jackson. Her, myself, and Minister Hope come together on the second Saturday of every month to bring you some, valuable financial information from the area of real estate, financial services, just some very great nuggets, some wisdom that you can get. So you can find that on either her personal page on Facebook, that's Juanita Corey Jackson, or if you're part of her group, Global Impact, then you will see the podcast in there. But I believe we'll be on tomorrow at 10 o'clock a.m. This is something, the next thing I'm getting ready to talk about is something that is forthcoming. It's a few months away, but you're going to start to see me post about it. If you're in the Atlanta area or you can get to that area, would be something great for you to come to. I'm a part of a book project with Collision with Purpose. Dr. Loxley Stevenson is the visionary and the head of that project. There is an event December 9th in Snellville, Georgia. So I'll be posting about that. You'll see coming. So purchase a ticket. Come on out. It's going to be an amazing time. And we've got a couple of missionary trips that are getting ready to take place. We have our team that's going to Ghana. They leave in just under 2 weeks. And so if you are interested in being part of our missionary trips, Money Mastery for Her, our philanthropic arm, we do short-term missionary trips every year. If you are interested in being part of a future trip, just, put your, either inbox me with your email or, put me in the comments or something like that. I'm interested in missions. and I will connect with you, right, to get you on our email list so you can know of the next trips. But we've got a team that's going to Ghana in under 2 weeks, like 12 days. They're 12 days from going out. And then we have another team that's going to Kenya in September. You can still donate to those missions, and I will make sure that I put up a link so that you can donate to that one. I believe this one here is the link to donate for the Kenya trip. So maybe you can take a screenshot of that. Your dollar goes a long way in Ghana and in Kenya. Okay. Your dollar in some cases is $8, $9, $10, $11, $12 in Ghana. Your dollar is like 138, 139, 140 in Kenya. Okay. So we appreciate and thank you in advance for your donations. All right. I think that's all that I'm going to mention at this point. Thank you once again for tuning in to the 42nd episode of The Wealth Seed. We'll see you next week with episode 43. I have been Lexi Johnson, international speaker, financial coach, consultant, strategist, host of The Wealth Seed. We'll see you next time. Bye.